Two people ask for the same thing, $30,000. One is offered 6%, the other is offered 29%. Same amount of money, same financial system, but completely different price. Over 5 years, the first borrower pays about $5,000 in interest. The second pays more than $27,000. The loan was the same size. The price of the loan was not. This is the quiet rule behind modern borrowing. The less safe you look to the system, the more expensive money becomes. And the people who most need credit often pay the highest price to get it. Money has a price. When a lender gives you cash today, they are selling you time. You get to use money now and pay it back later. The interest rate is the price of that time. For a strong borrower, time is cheap. For a risky borrower, time is expensive. That sounds simple, but the way lenders define risk is where the story begins. Before a bank sees your face, it sees your file. Credit score, payment history, income, debt, employment, bank stability, down payment, collateral, missed payments, and recent applications. To the system, these are not moral judgments. They are signals. A lender asks how likely this person is to pay us back on time and how much we can recover if something goes wrong. The prime borrower has a high credit score, stable direct deposits, low debt compared with income, savings, clean payment history, fast documents, and maybe visible assets. To the lender, this person does not look desperate. They look predictable. Predictability is valuable, so lenders compete for them with lower rates, faster approval, and fewer fees. The subprime borrower needs the same $30,000, but the file looks different. Lower credit, unstable income, old collections, credit card debt, no savings cushion, and no easy collateral. The lender does not see a person trying to get ahead. It sees uncertainty. And uncertainty gets priced as a higher APR, stricter terms, larger fees, or a smaller approval amount. A $30,000 loan at 6% over 5 years is about $580 a month. Total interest is roughly $4,800. A $30,000 loan at 29% over 5 years is about $952 a month. Total interest is more than $27,000. That is about $370 more every month and more than $22,000 in extra interest. It does not buy a better product. It buys access under worse terms. The higher payment is supposed to compensate the lender for risk, but it can also create more risk. If the borrower already has a tight budget, one emergency can break the payment plan. This is the feedback loop. Risk creates a higher price. The higher price creates more pressure. More pressure creates a higher chance of failure. Bad credit is not just a number. It is a toll booth. It can mean higher loan rates, higher deposits, worse credit card terms, fewer refinancing options, and less cash left over. The borrower needs extra money to improve the situation, but the situation makes extra money harder to keep. That is why poor credit can feel sticky. Collateral changes everything. A house, car, investment account, or business asset gives the lender a backup exit if the borrower does not pay. This is why people with assets can often borrow against them more cheaply. They are not only borrowing with income, they are borrowing with proof the lender can recover value. Income matters, but income is not the whole story. Two people can earn the same salary while one has low obligations and savings, and the other has rent, debt, childcare, and no buffer. The lender cares about what is left after obligations. This is why cash flow matters more than the salary people see. The system is not one price. A bank may say no, a credit union may say yes, an online lender may approve quickly but charge more, and a dealer may mark up financing. One quote is not the market. It is one lender's opinion of you. Shopping around matters because different lenders price the same borrower differently. Urgency is expensive. When someone needs money today, they have less time to compare offers, fix errors, wait for a better lender, build a down payment, or say no. Fast money often costs more because speed removes bargaining power. The person with savings can wait. The person without savings pays for speed. Rich people can often borrow cheaper because they have assets, income, advisors, tax planning, and multiple banks competing for the relationship. Most importantly, they can walk away from a bad offer. The ability to walk away is one of the most powerful financial advantages in the world. The lender does not price the full human story. It prices the file. And the file can turn job loss, medical debt, unstable housing, or one bad season into a higher cost of money. The practical question is how to become cheaper to lend to, pay on time, lower revolving balances, avoid unnecessary applications, keep documents clean, build a buffer, and compare lenders. Read the APR, not just the monthly payment. A lower monthly payment can hide a longer term, more years of interest, fees, penalties, or bigger collateral risk. Lending rewards stability, stable income, stable payments, stable accounts, stable housing, stable documentation, and stable cash flow. The more stable you look, the cheaper money becomes. When two people borrow $30,000 and one gets 6% while the other gets 29%, they are not really buying the same product. One is buying money with proof of safety. The other is buying money while paying a penalty for uncertainty. That penalty can add hundreds per month and tens of thousands over time. Debt can be a tool for one person and a trap for another. The goal is not to pretend the system is fair. The goal is to understand how it prices you. Once you understand the signals, you can start changing the price. Sometimes the most important move is not borrowing more money. It is becoming cheaper for lenders to approve.